What's going on, guys? Welcome once again to another new video on this channel. In this video, I'm going to count down the top 7 stocks to buy and hold. Solid dividend stocks are the best way to invest long-term with steady passive income paid to you quarterly, giving you some sort of cash flow. Well, unlike a majority of investors who rush to buy the highest paying dividends without prior analysis and end up losing their money, today I'm giving you the surest dividends to invest your money in the future. So if you're the kind of investor to be in the stock market for the long term, then this content is special for you. Be sure to watch to the end, and I'll keep you informed on the financials, statistics, and opinion on why I think these are the best stocks to invest in. But before that, hit the subscribe button and the notification icon to get all the latest episodes on arrival. Without wasting a lot of time, let's jump into the video. Number 7. AT&T. As obvious, you'll expect AT&T to make it to this list. Renowned for being a top wireless provider in the US, AT&T provides on more than 40% market share of wireless subscriptions. You can be sure this is a company that is here to stay, and its services will continue to stir much attention. AT&T has been around for a long time and, amazingly, it has been offering dividends for all those years without cutting for even a single quarter. Now that sounds a good reason for you to trust your money with AT&T. But even though this company's history shows that its profit has been wobbling up and down, the company has kept its dividends gradually increasing each year. Considering the high demand for data in this digital society, you can be sure AT&T's revenue stream will remain reliable relative to other companies. Furthermore, the market barriers for new entrants are incredibly high, which give you much confidence to invest in AT&T. With a dividend yield of 6.9% and a safety score of 66%, AT&T is comfortably able to cater for the dividends and still retain some profits to churn back into the business. If you ask me, I'll tell you with confidence that AT&T is still going to perform better in the future owing to the customer loyalty it has carved out in the wireless industry and the high barriers of entry for competitors. So, if you're looking for long-term investment, AT&T should always be in your mind. Moving on to number 6, we have CocaCola. Honestly speaking, Coca-Cola should be on every list when talking about which dividend stocks to buy for the long term. Coca-Cola is a strong brand in the food and beverage industry with a diversified product range. Unlike other companies which cut off dividends during the recession, Coca-Cola has gradually increased their dividends for over the past 60 years. Now that sounds amazing! Many thought that this super brand will be brought down by the current COVID-19 pandemic, but alas, it has stood the test of time and promises to perform even better in the future. With a dividend earning of 3.3%, Coca-Cola is for sure a reliable company to invest your money in. But if you're still in doubt about investing in Coca-Cola, then listen to this. Warren Buffett, considered the father of investment, and his Berkshire Hathaway investment firm holds about a 9% stake in Coca-Cola, an investment made way back in the 1980s. Now that's a huge investment for a company whose current market capitalization is $230 billion. This indeed is enough proof of how reliable Coca-Cola is and should give you the confidence to buy a bounty stake in this great brand. Simply said, Coca-Cola is a company you can count on for the long-term dividend portfolio, considering their diversified revenue stream ranging from Coca-Cola, Diet Coke, Sprite, Dasani, Minute Maid, Simply, Gold Peak, Honest Tea, and many more brands. Indeed, it is for sure that Coca-Cola is still going to produce good revenue in years to come. And number 5 is Home Depot. Well, let's face it, and the reality is that Home Depot is simply a people's choice when it comes to home furnishings in the US. With annual sales of $140 billion and nearly 2,300 stores, Home Depot is well positioned to grab the largest share in the home improvement niche. While Home Depot may seem a little unstable stock subject to short-term developments in the housing market and consumer spending, it has proven itself to be a huge source of long-term profits. The stock is up a whopping 760% since 2011, compared to around 200% for the S&P 500 in the same period. And to give you some confidence in the stock, dividend payments have risen from 25 cents a quarter in 2011 to $1.65 a quarter right now. Valued at $345 billion, Home Depot is simply a stock you want to buy and hang on to forever considering its high annual returns. Coming in at number 4 is Intel. Now, if you hold some reservations about investing in Intel, then the point is this is the right time to invest in Intel and hold. You may be asking why I recommend Intel despite the increasing talk about whether Intel still has the necessary capabilities to remain relevant, now that it's considering exiting the computer chip industry. Well, the harsh reality is that Intel's move is justifiable since the real money is in designing and patenting high-quality microchips rather than manufacturing them. This will clearly tell you why Intel, with its vast intellectual property, is worth many times more than smaller foundries that achieve small margins by producing computer chips designed by someone else. At the moment, Intel's dividends are soaring scoring a higher 35 cents, an increase from 18 cents paid out in 2011. The demand for Intel's semiconductor patents is just a sure indicator of how reliable Intel's revenue is. This is a dividend stock you don't want to miss in your dividend portfolio, considering the ever-increasing demand for semiconductor chips in this digital era. And on the basis, I can for sure tell you that Intel is going to overperform and its dividends are going to rise in the future. At number 3 is JP Morgan Chase & Co. Perhaps you're saying, but banks aren't my thing. Well, most likely you have heard of JP Morgan, and if you have, then you don't have insider knowledge about the stability of this bank's stocks. The US-based bank has developed into the most resilient financial stock on Wall Street since the 2008 financial crisis. While several banks, including Citigroup and Bank of America, were shaken off by the 2008 recession, JP Morgan remained firm. Although it cut its dividend during the low point of the financial crisis, the dividend was back to pre-crisis levels 5 years later. Right now, JP Morgan is paying a generous 90 cents, way up from its pre-crisis payouts of 38 cents by 2013. Furthermore, the stock of JPM, a company that's valued at $453 billion, has outperformed the S&P 500 since early 2007. And just to give you enough reason to consider JPM on your list of dividend portfolio, is how it has outperformed rivals such as Bank of America and Citigroup, remaining at the top of the U.S. banking industry. And number 2 is Johnson & Johnson. Talking of dividend kings, this is. Johnson & Johnson has consistently been increasing its dividends every single year for the past 50 years. Last year, it celebrated its 58th consecutive annual dividend increase. The large American-based company operated in a diverse portfolio of healthcare equipment, prescription drugs, and consumer health products such as patches and Tylenol. Despite its products scattered all throughout your house, J&J, as it's commonly known on Wall Street, still eyes more investment horizon, especially with this pandemic. It has a reasonable dividend yield of 2.83% and a payout of 65.7%. That gives you hope that this is a company that is going to keep existing in the future with good performance, and some of its process is plowed back to investment. J&J is the only pharmaceutical company that has developed a single-dose coronavirus vaccine, a development that has seen its stock value rise, and I hereby dare you to invest in J&J right now if you look into reaping good dividends in the future. J&J, with a valuation of $425 billion, has reliable earnings with a perfect AAA credit rating. The only other American company with such a high rating is Microsoft. And finally, at number 1 on our list is Procter & Gamble. Well, if you've not used a product of Procter & Gamble, you probably know a neighbor or a colleague who does. This American consumer goods giant has a diversified portfolio of strong branded products, ranging from Gillette's shaving products, Pampers diapers, and Pantene hair products, among others. While P&G does not show rapid growth or innovation, personal care products in particular provide a consistent revenue stream in both good and harsh times. That alone is surely enough to motivate you into getting a stake in P&G. Yep, that's it guys. I hope you enjoyed watching this video. If so, then go ahead and give us a like and drop your comment in the description below to tell us if these are dividend stocks to watch for in 2021. Also, let us know if you're interested in dividend investing. If you're new here, subscribe to this channel and turn on notifications so you won't miss out on the next episode. Thank you so much for watching, and I'll see you in the next one. Goodbye.